Hello and welcome to another Wade Gordon Signals tutorial. Now that you have an idea of what binary options are and the asset groups involved, now is time to gain an understanding of some basic market principles. We live in a 24-hour global economy with stock exchanges all over the world. The main trading sessions are the Asian markets, the UK and European markets, and the US markets. During these sessions, only assets listed on the relevant stock exchanges can be traded. So, for example, Apple, which is listed on the US Nasdaq or indeed the Nasdaq itself, can only be traded on most binary options trading platforms when only the US markets are open. You wouldn't be able to place a trade on these assets any time when the US markets are closed. Currency pairs, however, can be traded 24 hours a day, as the foreign exchange market is OTC and has no central exchange. From what we covered in the previous tutorial, there are four main assets groups that we can trade using binary options. These are stocks, indices, commodities, and currency pairs. These groups can be separated further into risk-on and risk-off assets. When things are looking good in a country's economy or the global economy as a whole, trader and investor sentiment is risk-on. Investors and traders will move money from safe haven assets such as gold, the Japanese yen, and the Swiss franc into assets that offer a higher rate of return. These assets generally tend to be stocks, in particular banking and technology, indices related to the economy, and the domestic currency of the economy. When things are not looking good in a country's economy or the global economy as a whole, trader and investor sentiment is risk-off. Investors will move money from riskier assets such as stocks, indices, and the domestic currency into safe haven assets that protect their money. As we mentioned earlier, these assets generally tend to be commodities, specifically precious metals such as gold and silver, and safe haven currencies, the Japanese yen and the Swiss franc. This in a nutshell is what causes the markets and asset prices to move, this constant change and shift of sentiment from risk on to risk off and vice versa. This concludes this particular tutorial. This was a short lesson but a very important one indeed. If you're still a bit unsure about risk on and risk off, we recommend going over this lesson again before proceeding to the next, as in the next lesson we'll be incorporating the concepts we've just covered here. We will go into detail about how we can find out which direction specific assets are more likely to move using the economic calendar. We look forward to seeing you then.